Gold's become a tough sell. It's hard to convince anyone that runaway inflation's just round the corner when prices are flat, even after years of quantitative easing. It's hard to convince anyone that gold offers a great defence against impending disaster in China, the Middle East or Greece either. When China's hard landing keeps being delayed, a deal's been struck with Iran, and the biggest worry that international investors have at the moment over Greece is deciding which books to pack for their holiday there. This morning's 5% plunge in the gold price still came as a surprise, but the long-run picture looks pretty grim. Gold's had 5 falls bigger than today's since it peaked in 2011, and it's been whacked by more than 40% from that top. You can see that there with gold, for some reason, in red on this chart. Now, perhaps most embarrassing for gold bugs, investors who chose to buy shares on the day that the market peaked in October 2007 have now made more money than if they'd bought gold, assuming that they reinvested their dividends, of course, although they would have had an equally wild ride either way, with obviously gigantic losses if they'd invested in shares. You can see the S&P 500 there in green. Now, one perennial question about gold is whether the price is a sign of anything that matters in reality. Detractors dismiss gold as what Keynes called barbarous relic, say really doesn't matter at all. Yet its price moves over the medium term are fairly easy to explain, linked to fears of extreme inflation, to commodity prices and to worries about financial chaos. All of those have been in retreat for a while now. Now, with banks looking better, at least outside Greece, and inflation having all but vanished for the moment, gold looks pretty much like it's just another commodity. On here, I've rebased gold, again that's the red line, against a broad index of commodities, including oil, metals and food prices, which is shown in blue, and I've done that since 1999, which is the year that the long gold rally began. Now, the two performed fairly closely together, even taking into account the oil price bubble of 2007. That's when commodities went completely haywire and obviously gold got left behind. But the overall result at the end was that the two of them are up almost exactly the same amount. For the past 15 years, the main mover of commodity prices has been demand from China, with its boom driving everything from milk powder to iron ore up to record highs before their big retreats. Emerging markets are particularly reliant on exporting commodities to China, and they naturally enough have been hit hard. So the relative performance of emerging stocks to developed stocks, that's shown by the green line, with emerging markets outperforming when it goes up and underperforming when it goes down, that's moved very closely with commodities, as you'd expect. And of course, also therefore, with the price of gold. The common factor behind all of them has been China. Now, one doomsday scenario at the moment has gold benefiting as China's debt-ridden economy implodes and its people rush to buy into a solid asset. But perhaps those buying gold should be hoping that the country recovers its appetite for heavy industry and starts sucking in commodities again, boosting the whole commodity complex and the emerging markets, and perhaps again taking gold up with them.